The next panel discussion is on our emerging market economies, sitting ducks, or can spillovers be managed? Our panelists for this session are Dr. Sajjid Chinoy, member of PM Economic Advisory Council and MD and Chief Economist, JP Morgan; Ms. Sonal Varma, MD and Chief Economist, Asia, Japan, Nomura; Dr. Samiran Chakraborty, Chief Economist, Citibank; Dr. Mridul Saggar, and the session will be moderated by Dr. Tirthankar Patnaik, Chief Economist, NSE.
Can we start? Can we start? So, is Rudro around? He's here. You did have the graveyard shift, but you did discuss things which were very important. In fact, absolutely, as we heard in the morning panel, Mr. Dave saying, not a week goes by when we have either some function or we get invited to talk something on AI. The technology-based aspects or digital finance was something equally interesting. So we had crypto and we had DeFi. You made sure that no one really slept. So I have the onerous burden of talking about something more mundane, but dare I say equally important. I mean, I'm talking about, do we really see spillovers from emerging markets? And I have the, the good fortune of asking my panelists some very important, absolutely important questions. These are the questions that we look forward to in the credit policy. What are the changes? What are the views that we have on these very pertinent questions? So with that, my first question is to Dr. Saggar.
Starting with me, okay.
I have to start with you, sir.
Okay.
Are emerging markets sitting ducks to spillovers?
Well, I won't say we are sitting ducks. We can be sitting ducks if we want to be sitting ducks. So we have tools. We ought to build buffers. We ought to use them. So we need not be sitting ducks. But if we choose to be one, then it's our choice. So the fact remains that the global balance is tilted. I mean, today the financial cycles have deepened. The financial cycles have become very strong. The so-called trilemma, as you know, the Helen Ray's piece showed how the emerging markets really face a dilemma, so they need to curb capital flows. I think there was some morning discussion when Anant was here, the chief economic advisor, and there was this issue of capital flows coming very strongly. So in essence, what we need to do is we need to build buffers in good times, and we need to build macro financial stability. So that's why this theme of the conference was very much, and this reflects the counter-cyclicality itself, because today we are not in a crisis. Today the emerging markets are not facing the spillovers, but it's the good times that we need to think about it and set in place the policies which should be there. Reserves have a cost, yes, but we need reserves. So we can't really bank on the global financial safety net. So we need to sort of, I mean, reserves also are part of global financial safety nets, but we can't really be dependent on swap lines. We can't really be dependent on IMF. Those are resorts we need to take later. The first choice is build your own buffers.
We may choose to be sitting ducks if we want to, and reserves are important. Sonal, if I could request you to take us into this a little more in detail. What happened in 2013? We had a taper tantrum. How have emerging markets coped with taper tantrum, and how have we improved things so far? How can you give us some examples as well?
Yeah, sure. So I think like on a day-to-day basis. Yes, thank you. So on a. All right. So on a day-to-day basis, we are seeing that these spillovers from US policies onto emerging Asia has declined over a period of time. And I think the question to ask, therefore, is why are the spillovers less? I don't think anyone is arguing that spillovers from what the US does or how US rates move onto domestic interest rates, domestic FX because of capital flow channels. I mean, the spillovers will be there. But what we have observed is the spillovers have come down. And I think, for India, which was classified as a fragile 5 back in 2013, this is also true of Indonesia, which was also part of the fragile 5 bucket. We have seen some improvements. So one, unlike the developed economies, we have seen, I would say, more prudent policy response to COVID from a lot of emerging economies, particularly EM Asia. So you are not in that position where fiscal and monetary have been excessively loose or inflation out of control. We've seen a lot of focus on better fiscal finances in these countries. We've seen, the monetary policy framework, inflation targeting framework being quite active. That's been an important pillar. One of the big lessons from 2013 was we needed, as Mridul said, have your own FX reserves buffer as the first line of defense. So countries have done that. If you go even further back to 1998 Asian financial crisis, one of the big learnings for countries was, you should not be pegging your exchange rate, but allow the exchange rate to be an automatic stabilizer. So countries have followed a more flexible, not fully flexible, but a more flexible exchange rate policy. There was a lot of debt taken in foreign currency, short-term debt, which was difficult to roll over. We've seen countries actually shift the external debt more towards local currency. So I think, one, I would say spillovers will be there. Two, EM as a bucket, we tend to club it all together, but it's a motley crew. There are good EMs, there are bad EMs. And what we've seen, particularly in EM Asia, are countries that have tried to improve their fundamentals because there's no substitute for good fundamentals. And on top of that, you build your safety buffers in terms of FX reserves or swap lines. But what I would call sort of a more eclectic approach to how do you deal with currency pressures that countries face. So I think things are changing. We cannot classify everyone in the same bucket, and EMs are not just sitting ducks anymore.
You made a very important point. In fact, after the Asia crisis, the EM response in the global financial crisis was far better. Relatively speaking, one remembers the fixed exchange rates that countries like Indonesia, others had put in around 97, and what kind of issues had cropped up around that time. So clearly much higher forex reserves, much better buffers, and in general stronger macro fundamentals, which leads to better growth. Shifting gears a little bit, Sajjid, my question for you would be, see, we had the VO numbers come out earlier in January,
right.
And which posed a higher growth for the world, about 3.1% if I remember right. Who do you think will be the major gainers and losers
Thanks, Tirthankar. Great to be here. Mridul, thank you for an excellent conference. Before we look forward, I think it's important to look back. And we sometimes take these things for granted. But if we were having this discussion last year in February, and we said the US has raised rates by 500 basis points, where would US growth be, right? 2022 had been 1.9%.
Yeah.
Most people with the hand on the heart have said, close to recession, 0.5%.
Yeah.
US growth accelerated from 1.9 to 2.5% in 2023. Global growth has been far more resilient, despite the fact that China disappointed last year. Global growth only slowed from 3.4 to 2.7. So I think the first thing we have to acknowledge and question is significant resilience, right? Where did that resilience come from? Everybody was so fixated on the monetary tightening and the transmission from 500 basis points of rate hikes that you forgot that there were other things moving in the system. This was not what economists call ceteris paribus, all else equal, because all else was not equal. And what was happening at the same time was, well, we were focused on the demand curve, the supply curve was normalizing. That there was more normalization of manufacturing goods supply chains, which meant that there was higher growth and lower inflation. And there was the supply side moving in labor markets, especially in the US, which we don't again fully appreciate. Peak labor force participation between prime age workers, 25 to 49, is today at the highest level it's been, higher than previous peaks. So that return to the labor force did happen, right? And so you had other things, and of course, in the case of the US, fiscal policy turned pro-cyclical in the sense that, despite growth doing better, the fiscal deficit correctly measured expanded by 3% of GDP, which was bizarre because even as the Fed was fighting to push inflation down, fiscal was moving the other way. But the short point is that we've seen more resilience of the global economy, of developed markets, right? And that's the first point to acknowledge. Now, with that resilience has come divergence. That to your point, some geographies have done much better than the others. I think the US has outperformed, Europe has disappointed, Japan did well in the first half of the year. So there is this geographical diversity, and you're getting a sectoral divergence as well. That goods fell very sharply, services held up a lot. So it was a complicated story, and I think going forward, one can expect much of the same, in the sense that US growth is expected to still hold up relatively well, as per the IMF forecast in 2024. Europe is going to increase, but still be less than 1%. So we don't have time for it today. The big analytical question is, why has US done so well and Europe not so well? And if Europe has not done so well, why are European wages so sticky and European labor market so tight? But that's the whole question.
Into recession, I suppose. Yeah.
Well, the supply side response was much weaker in Europe, and that's a whole PhD thesis about flexible labor markets in the US versus much less flexible labor markets in Europe. But let me summarize by saying we've seen tremendous resilience around the world because of the factors I mentioned. Households in US, consumers in particular, have been the epitome of this resilience, right? China has disappointed. The question going forward is this resilience going to be accompanied by lower inflation that makes for this perfect soft landing in 2024 that markets until recently had priced in? Or is the resilience going to be too much of a good thing, and that you will still, the odds of a hard landing have picked up? I'll end by saying the following. You looked at the inflation print of the US that came out two nights ago. Services inflation remains very, very sticky. The reason core inflation has come down is because goods were in deflation. And that was in large part because China was exporting disinflation. Now, our China economists say that process is troughed. At the margin, China's disinflation exports will be lower. If you look at the US inflation basket, goods prices have now begun to stabilize and pick up. And that, in a way, is not good news, because it suggests if goods inflation remain where they are and services don't come down and labor markets remain tight, then all these expectations that we have that central banks can start easing interest rates in the next few months and engineer the soft landing, will not be met. So I'll end by saying lots of resilience, but the resilience doesn't necessarily, resilience with divergence, sectorally and geographically, but that doesn't reduce the policy challenge that lies ahead.
No, it doesn't. It doesn't. In fact, Samiran, my next question to you is, when do you see a pivot, if at all? Sajjid says it's very difficult.
Did Sajjid say that it's very
No,
difficult?
no, no.
I said don't take it for granted.
I'm not
Little
taking it for
difference.
granted, but what do you think?
First, let me thank Mridul for bringing a macro conference into Mumbai. It's always been a thing of Delhi. Being a Delhi boy for a long time, I miss it in Mumbai. So I hope we get to see it every year. Yes. Sajjid has touched upon quite a few things, and I'll say where I agree or disagree. But first, we need to understand that while Sonal was making a point that EMs are different, we have to also understand that increasingly the nature of spillovers are also different. Mm-hmm. Our natural bias is to think that the spillover is only coming from the developed world. I think we have to increasingly start thinking of spillovers coming out of China. If we have this same topic being discussed in Singapore, I can tell you that the direction of the discussion will be very, very different. Everyone there is worried about how China demand spillover, which was the story of the past, is now being converted into China's supply spillover as the story of the future. Because China is sitting on now excess capacity on a whole lot of stuff which these countries were good at exporting. So how these countries now, these EM countries now cope with their new growth model? Because ultimately, while we can think of the economic stability parameter on one front, fact of life is that EMs need to grow faster than DMs. So you need those drivers of growth also to be in place. And that's where I think it becomes important that when we think about global spillovers, we just don't think spillovers arising from Fed rate cut. We also think about how the spillovers will come from a place like China. And there, I guess the one point which Sajjid very clearly brings out is this goods versus services issue. And I think where we economists got it wrong in hindsight is that we focused too much on the monetary policy to control inflation and somewhat underplayed the role of fiscal policy in boosting inflation. For a very long time, fiscal was contractionary across the world. And suddenly fiscal turned very expansionary. And we kind of did not factor that enough into our calculations. And the other area where probably we got wrong is this labor market being extremely tight in US and the spillover effects of that. Fact of life is that if US wage growth is more than 5%, then on a sustained basis, you cannot have US inflation at 2%. So then everything boils down to Fed cutting, not because it has reached its 2% inflation target, but because it feels that the real rate in US is much higher than what the growth equation would suggest. City economists believe that US will go into recession sometime in the middle of the year. The main argument seems to be coming from the labor market side, that certain labor market indicators are turning softer. And in the past, we have seen that that softness can very quickly translate into higher unemployment rates and lower wages. So if that sort of a thesis one brings in, then through the real rate argument that then even if real rate is 250 basis points, that's too much for an economy which is getting into recession or coming close to recession. You could argue for rate cuts. Citi's house view is of 125 basis point rate cuts in 2024. It's a bit of an outlier in the market. But the fact of life is that if the nature of inflation is a bit more structural and not just cyclical, then this might not be true. On the other hand, if China is exporting as much deflation as they are today, then who knows, 6 months down the line, we might just say that, look, what's the problem? Fed can cut as much as they want.
So I have a related question, Samiran, just for you. Do you see divergence? I mean, you answered us for the states, but where do you see other major central banks, what do you see them doing?
So at this moment, if you look at it, Japan is in recession.
Yeah.
Europe is in recession.
Near
UK is in recession.
Yes.
Except for US, practically the entire DM is in recession. So there is a clamor for rate cuts everywhere.
Yeah.
I mean, of easing of monetary policy everywhere. The only thing is that once central bankers have got their sort of forecast so badly wrong on inflation, would they be that much more cautious in doing the first rate cut? Would they want a bit more comfort that actually the inflationary trends are definitely down? They don't want to get shocked again that they ease policy and then 3 months down the line, inflation picks up. And who knows, we have not yet got there, but there could be this whole geopolitical thing, Red Sea, whatever, creating another round of supply side shocks. So somewhere, although the dynamics are very different in different DMs, but in one aspect, the central bankers everywhere might be very similar, that they will be cautious in doing the first rate cut.
Mridul, question to you. You know, you were a part of the MPC. What do you think will be our central bank's thoughts on what Samiran just pointed out?
Well, I thought Ashima was here.
I think you need a mic. You just have to press this long press. No.
Hello. Yeah. So I was saying Ashima was here,
Yeah.
who is the current MPC member. Chetan is here, who was past. But since you're directing it to me,
I have you here now.
So let me make it one thing very clear. The way I see in India, India didn't do the aggressive monetary tightening which the advanced economies did. So central banks all over the world were behind the curve. So that's one thing. But the advanced economies have made good by significant tightening. I mean, you know, from March of 2022 to July of 23, 525 basis point is the most aggressive Fed action in 4 decades.
Since Volcker.
Yeah. So, in essence, I think now they are reasonably soft landing. I'm not saying that the risks, as my colleagues here have pointed out, like from the market, basically there are a significant amount of risk still there, and that's why that may delay the pivot what you are talking of. In India, we didn't do that kind of tightening anyway. So is there really a need to pivot early? I mean, we have to be very careful about it. So long period of higher than the target inflation, some kind of averaging behavior is there, also requires that you shouldn't let the price expectations of a higher order anchor for long. So you don't need to prematurely ease. But yes, if there are more shocks global on the way, at some stage, if geofragmentation increases significantly and there is a global downturn, which also spins off into India, then some action would be called for. So when that happens is anybody's guess. So as unknown was Anand Narayan's theme. So that's something I won't want to hazard a guess. The earliest we could see is June, but it could be very long period, and that makes very little sense to start on a easing cycle when you know you can't really cut much.
You've raised the same concerns that Samiran did actually. You really don't want to move first and go wrong.
So it's not move first among the central banks. That's not probably the consideration. So what is more a consideration?
Move early and go wrong.
Yeah. So that's fairly, I think, logical. I know Sonal has a view about a stronger slowdowns she's been holding for over a year, but
Sonal, Silvu, please. Yeah. Let's hear about it.
About
you have a stronger view on on the RBI pivot, as Mridul says?
I mean, I think RBI will do how macros play out. So I think the central view that RBI has right now is growth is strong, sustains into next year, private capex is picking up, it's broad-based, and core is down, but headline is still up, and therefore we need to basically stay on the path, and which is fairly fair in terms of the current macro outlook. I think where we have a more divergent view is essentially, as Mridul was saying, in terms of the durability of growth next year. Primarily because when we look at the composition of what's driving growth right now, it seems to be driven largely by public capex and discretionary demand on the urban higher income side, whereas rural and private capex, I would say there are pockets of strength, cement, iron and steel. Autos, but it's not the kind of broad-based capex which is what we want. So if that is the nature of growth, then in terms of the forward-looking outlook, we have tight liquidity. We are tightening on macroprudential norms on unsecured loans, which from a prudential point of view I completely agree with. But of course, this will have some spillover in terms of driving forward discretionary consumer demand. We're getting into an election cycle. We know that once the model code of conduct comes into play, new awarding activity will slow for a period of time. So it could mean slower capex and spending over 1 to 2 quarters. So if we put all of that together, then I think our basic view therefore is FY25 will see a softer growth, particularly as we enter in the first half. So we are looking at around 6.2. I think, and this is one debate, as economists we've been having, is why core has seen such a significant disinflation despite, growth at 7.3. My view is India is a supply-constrained economy. We don't see disinflation till there is weakness in demand. I think, multiple things might be happening. You've seen commodity costs come down. You've seen consumption being soft. Maybe statistically adjustments haven't happened. But the underlying run rate on core is such that I think the convergence of headline will happen to core in the back half of 2024 calendar year. So under that thesis, I think the pivot should come through. But I'll take a step back. I think more than repo rates, it's really liquidity that drives transmission in India. And I think the fundamental concern right now is that banking system liquidity is quite tight, and which will have forward implications on credit creation also.
The recent budget's thought process going from a 5.8% fisc to a 5.1% fisc and then on to 4.5 by FY26. Does that factor in this calculation? I mean, Sajjid? Can you hear me? No, the long press.
Thank you. We have a monopoly here. So before I talk about fiscal, let me just put my 2 cents on monetary. And this may not be a popular view. I think the core inflation argument, Sonal, in my mind is less of a puzzle, because I think you have to look at stocks and not flows. If you this is what we've been using to guide India's recovery or EM recovery from the pandemic. Just draw a pre-pandemic path and say, if we were having this discussion in Jan of 2020, and I said India's potential growth is 6%, I think there'd be few people who would object to that. If you draw a 6% line, right, and then you ask yourself, what is the level of output today? Despite 7% growth this year, we're still 4.5 to 5% below that, right? And that to me tells me there's slack in the economy. And you can see the slack in parts of the labor market. You can see the slack in capacity utilization. You can see the slack in the evolution of wages. So I haven't been particularly surprised that core has come down, because slack will exert this gravitational disinflationary force. In my mind, much of the core inflation pickup last year was goods. Input prices surged to the point that firms couldn't but pass it on. The minute input prices have come down and commodities have stabilized, goods inflation has come down. Services is the dog that didn't bark in India. Services inflation, with or without housing, has been consistently below pre-pandemic levels. And because services is your non-tradable inflation, it kind of reinforces the hypothesis that labor markets are not that tight in India. There is slack, and therefore you didn't see much non-tradable inflation. Second quick point I'll make is, I know that Chetan's here from the MPC, Mridul is here, but Monetary purists would say that in an inflation targeting regime, you should use rates and liquidity for inflation. And if there's a financial stability issue, you should use macroprudential measures. And I completely agree with that allocation of labor. But in India's case, there are many tensions in emerging markets. One tension is, and I think Sonal alluded to this, is inflation is much lower. There's comfort on core, headline, hopefully there'll be comfort this year, but there's a lot of financial exuberance. And we've seen the RBI use a lot of macroprudential measures to just slow things down, right? Credit, quality of credit, you'll see a huge BOP surplus this year, equity valuations. Now the conservative or conventional thinking is you use different instruments for different objectives. But you know, if you read Bernanke's latest book, Bernanke changed his mind. 15 years ago, he thought the same thing, that you should not use monetary policy instruments for financial stability objectives, right? You should use macro-pro measures. But then he realized 10 years later that this separability argument is clean on paper, but very messy in practice, because monetary easing, especially if it's premature, actually is a lot of evidence now to show fuels private sector risk-taking. So in a way, if you're putting on more macro-pro measures to reduce the financial exuberance, but you're easing monetary policy at the same time, in a way, you're undermining your own objectives. So I'm not saying that should be the primary objective. Inflation targeting has worked very well. It should focus on that. But you can't help but think that central banks will also take into account there are some situations where you want to be cognizant of the implications of your easing on financial stability. Very quick point on the fiscal. I think it was a consolidation that was bold, necessary, much needed in my mind, and therefore needs to be complemented. Despite very strong growth this year, India's public debt to GDP, we've discussed as Mridul and me, will actually increase. And that tells us that in peace times, outside of crisis times, the consolidated deficit is much too large. So to stabilize debt and bring it down and create space for the next shock, which prudent macro policy must do, the combined deficit has to come down. The state deficits will actually widen this year after a long time. So the center had to do what it did, and I think that process has started, needs to continue, which goes back to Sonal's point. If the public sector is forced to retrench, then growth prospects are going to depend a lot, and monetary policy is constrained from overacting for the reasons Mridul mentioned, then the growth prospects will depend on how vibrant and how broad-based private sector growth is.
So before I go international again, Samiran, one last question here. When do you see private corporate capex coming back? Yeah, we know some parts of the system have seen. 10 years now, please.
First, I think the problem in answering this question in the market is that people don't have a good sense of what reference point to use. So the natural instinct for people is to think 2010-12 or 2006-8 and say that, oh, private capex is nowhere close to those times. And I'm quite sure that we are never going to get back to those levels of private capex. Those were exceptional levels of private capex. So those 37-38% of GDP investment to GDP ratio, I don't think we are going to achieve in this cycle. Part of the reason simply is that the nature of private capex is changing. I just give this example that the data that RBI puts up on spending on private capex, or rather lending to private capex, that data has a size parameter in it. And in 2012, there were 28 projects which were quote-unquote large projects. And then for next 8 years, the sum total of large projects did not reach 28.
Okay.
So we are not doing large projects anymore. Part of the reason is that we are not doing, say, let's say a thermal power plant, which was a large project always, or large airports, those kind of stuff. So that itself will kind of bring the overall capex number lower. The second issue is that we are doing huge amounts of digitalization, mechanization, which improves productivity significantly, but is not as capital guzzling as some of the other sectors. So that improved productivity in turn would require less capex. And the third thing is that we have to understand the mindset of private producers in this country. they had 10 years of a capex drought.
Yeah.
And after that, had shocks like COVID, Ukraine, now Red Sea, Israel, Hamas. Every day you open the newspaper, there is something new of that sort. In this sort of an environment, for anybody to think of a 8-10 year long private capex horizon is extremely difficult. So the capex horizon is shrinking to 3 to 4 years, where people are more comfortable, they have demand visibility. By the way, the points that Sonal and Sajjid, they were making, if those points are correct, that the demand side is actually significantly weak, then the need for private capex will be that much lower. We should not forget that in last post-COVID in 4 years, the cumulative inflation has been more than 30%. And a large part of this country's population has not seen income growth of more than 30%. So that is itself in depressing demand. So on top of the uncertainties, if there is uncertainty over demand also, then we might actually see private capex being delayed or less than what the market wants it to be. And this is despite all the great arguments on how the quality of balance sheets on both private corporate side and the banking side has improved tremendously, how the government policies have become more favorable towards private capex. Despite all those things, because of the reasons that I mentioned, you could see a more muted private capex, or you could have to change your lens to understand private capex.
How do I see 4 years of 7+% growth then?
So the growth number is mostly coming from public capex, or a large part of it is coming from public capex.
Yeah.
And part of this is also catch-up consumption spending. The consumption that did not happen over COVID, that part of that is happening. Sajjid mentioned the number of the gap between where the trend line GDP versus current is 4.5. But what is interesting is that he was here last year, he would have told that number to be maybe 10%. Or
10% gap?
8-9%.
5, okay.
So that gap is narrowing, and that gap has to narrow. So that will give you growth to some extent. But this growth is not what the private corporate would want to see. Wants to see a more sustained demand growth, which probably at this moment is not happening.
Thank you.
And could be the reason why core inflation is also low.
Yeah, that's down below 4%. Mridul, my question to you, what kind of financial safety nets are available today or needed in the international architecture to prevent, or, we've sort of come to a position here that, I think all EMs are not the same. To use Sonal's terms, they are a motley crew. Some have done well, some have not really done well. But do you see any room, or is there any need for any change in the current, international financial architecture to be even more protected, towards future crisis?
Basically, a lot of questions again here. If I see the global financial safety net today, it actually comprises of the reserves which the country hold, but that is pretty lopsided in the sense that few countries have very large reserves, and it doesn't really afford a safety net in true sense to everybody. I mean, if you calculate, around 90 odd countries account for 97% of the international reserves, and the rest account just for 3%. So the other half doesn't have reserves. So there is an imbalance on whether you have safety net for everybody, especially the low income countries don't have that safety net of reserves. Second issue which comes in is that in terms of the size, see, if you need to add the reserves with the IMF firepower, and then the bilateral swaps. And we have here from Bundesbank, so he'll know about the ESM a lot, and the regional financial arrangements, which also are significant. Both the bilateral swaps and the regional financial arrangements today provide a safety net bigger than, each of them provide a safety net bigger than the IMF firepower. And that's a very significant shift in what the global safety nets exist now. Are they usable? Clearly not. I mean, very few of these RFAs or the BSAs, the bilateral swap agreements, have been used. We have entered into BRICS CRA arrangement. We have swap lines with the SAARC countries. The swap for the SAARC countries are often used, but rest is not used. Now, can we have a bigger firepower with the IMF, which is sort of well managed? But is there a willingness in the advanced economies to do those reforms? I don't see necessarily, because quota revisions have lagged, quotas have been diluted, they have been substituted by new arrangements to borrow or bilateral swap lines, and therefore the effective power of the global financial safety net has weakened considerably. I think we need to address this rather than the sheer size issue, but the size issue is also worrying me because it has come down from 4.3 trillion pre-pandemic to 3.5 trillion after the pandemic, and global debt levels are now rising sharply. I mean, at 116%, 112 for last 2 years of the GDP on an average for the globe. And that can, for some of the countries like US, it's going to head to 136, 139%. So that's a big worry to me that global financial safety nets are falling while debt levels are rising.
I need to bring geopolitics into the game now. See, what you mentioned, Mridul, presupposes a lot of coordination, a significant level of coordination, which has emerged out of the post-World War II rules-based international order, which is increasingly being questioned today. There are a lot more claimants to the throne, as it were. So where do you see cooperation in this framework, and how do you see the lack of it affecting this protective armor that countries have?
Yeah, so I think we are shooting ourselves in the foot, because this lack of global coordination is really a huge economic cost across countries. I mean, the geopolitics has taken the front role. We have to cope with these harsh realities that's happened, but nobody today talks that free trade is the best policy. Even the advanced economies have stopped talking about the free trade, and they're all talking about the second best and the third best practically. So global growth is dragged because of that. Global finance is dragged because of that, and we see more bubbles and bursts coming in. So I think we need a very strong sort of a counter push from the academics, from the G20 to sort of counter this trend, because otherwise it's a Nash we are all facing. A Nash equilibrium is falling.
I want to shift a little bit towards supply chains, Sonal. What do you think is happening with supply chains today? How are countries dealing with? We've heard about significant supply chain issues over the last 2 years or so. Where do you see things improving? And a related question to you would be, as countries are shifting away from China, there's a China +1 strategy that many people sort of talk about. Where do you see India come in?
Right. So I think, so ensuring enough supply for, so one is the aspect of shifting supply chains from China. I'll take that separately. Yeah. And then you have the supply chain issues because of these geopolitical disruptions, climate change, in terms of access to food, energy, critical minerals, which is one priority for most countries today. I think like in terms of building our own resilience, therefore it becomes important to build strategic reserves of food, oil, in order to have that buffer in case of any particular shocks. It is very important to diversify our supply chains, wherever we are procuring our energy or food. Thankfully, we are largely self-sufficient, barring a few products. So there the focus has to be more on how do we improve production productivity more going forward. But I think still in the case of other critical food items and on energy, like I think diversification of supply chains is quite important. You cannot any longer put all your eggs in one basket. And the entire sort of management of supply chain inventory has got to move from just-in-time to just-in-case inventory cycle. So the thought process around how one does inventory planning, etc., needs to change. So that's one part of it. There can be more government-to-government, coordination. Yesterday, the governor talked about food corridor, critical mineral corridor. So there are those issues. The second aspect is the shift in supply chains from China, which is basically the goods supply chains which are moving away from China. I mean, we've done some work on this. I would say, first of all, China is still very important. Even with all the shifts that have happened, like majority of the production across majority of the products is still happening in China. So when we are talking about the pie that is moving away, it's actually a fraction right now. It could turn into a flood over time, but as of now, it's a small pie. What we find is, though, that this reallocation of supply chains is benefiting different countries in different product categories. So Vietnam is seeing supply chains move both on labor-intensive product categories as well as on electronics and others. You have the likes of Bangladesh, Cambodia, which is more textiles-driven. Mexico is seeing supply chains on auto move because that's also closer to US, so that becomes much easier. For India, the benefit we've seen is mainly on mobile phone on the electronic side, where back in 2015, India's share in global electronics exports used to be around 0.3% of global exports. Today, that number has gone up to around 1% and rising. So we've seen a benefit on electronics, but some of the other supply chains that are moving from China, I think we still need to see them move into India. So uprooting supply chains is not an easy process. So this is a 3, 4, 5-year story we are talking about, but we need to essentially ensure that we benefit from more of these firms that are moving away from China, and also move up the value chain so that the value addition that we are doing domestically is increasing, and we are not just doing the assembly job.
I agree. The value addition will take time. I mean, one is very pleasantly surprised with India actually exporting iPhones. This was not thinkable maybe 4 to 5 years back, but now today we are doing it. I have about 5 minutes. I'll open it up for questions. Please. Please identify yourself and keep the questions very short. Are there any online questions? Yeah.
Patch. So I have a question regarding RBI, RBI's move. So now RBI there's a kind of a thinking that RBI will move after the Fed moves, and this is the theme for the EMs generally. What we have seen, we had a session earlier as well. There was discussion of India decoupling with the US in terms of monetary policy decisions. What is the take on that? Are we really in a position to decouple with the US, or are we still worried about the carry trade that will come up? If
you spoke about it, but you want to talk about it
very quickly. I just brought in the discussion out. I think one has to distinguish between EMs not going through a crisis and the resilience they've built, but the fact that they haven't still extricated themselves from the trilemma. And you're pointing to something very important. In Latin America, many EMs raised interest rates much before the Fed to levels that were much higher to protect against the implications of what the Fed was doing. In Asia, the FX buffers worked, but that doesn't mean that monetary policy is fully independent. And I'll give you a small example. From last September onwards, what you saw was de facto tightening of monetary policy in many Asian central banks using different tools where liquidity was tightened so that overnight call money rates or short-term money market rates went up. And that was, in a way, designed to reduce pressure on the currency. So I think while we've made progress on that front, I think it's too simple to say that buffers allow EMs to completely divorce their monetary policy from the Fed, because there is still this significant preference to intervene in the FX market. And you're seeing this across Asia, in particular in this cycle, that there's a lot of intervention in the FX market. So as an economist, my preference is that if you want to break the trilemma, something has to give. That capital accounts are now open and to some extent irreversible. And so the choice is, if you want to have some more degree of monetary independence, of course there are never corner solutions, you have to let go of the FX a little bit. But because Asian central banks have been intervening so much in the last 6 months, it's a sign also that they don't let go of the FX, and that means that interest rates cannot be fully divorced. Last thing I'll say is, this is going to create a tension, because the cyclical position of the US and many EMs is very different. So if EMs, even to some extent, are importing tight monetary policies from the US, that may not be in their best interest given domestic growth inflation dynamics vis-a-vis where the US is.
Thank you, Sajjid. We have an online question which I will pose to Samiran. What happens to India after 2 years when, say, the Chinese economy starts recovering fast?
There seems to be an assumption in the question that in 2 years' time, Chinese economy will start recovering first. So, I'm going to play with the assumption and not question the assumption per se, because then that will be a different answer altogether. So there are two different channels one needs to look at. One is what happens to the real economy and what happens to the financial economy. If you look at the real economy part, the fact that world GDP growth is so weak and below trend in the last couple of years is partly because of China. And if China is recovering fast, that would mean that the entire supply chain along with China, and we'll go back to what I was saying a while earlier, that there was a big chain which was dependent on the Chinese demand. That chain will start doing well, and that would mean that overall global growth would improve, and in turn that should help India as well. Typically in periods of high global growth, it's a tailwind for almost everyone. Then no one talks about the relative growth. If you go back to that 2004 to 2008 period, no one complained that China was growing at 10%. Everyone was happy with India growing at 8%. So that sort of a thing will work. The financial side is more complicated. I think there is a ongoing thesis in the market that capital is coming out of China and going into India. Honestly, I need more proof of this thesis, because if you look at the portfolio equity capital, most of the Chinese investments are out of EM funds. And similarly, Indian investments are also part of EM funds. The India dedicated funds are actually very small in number. So if the EM fund starts getting more flows because China is doing well and rest of the EM is also doing well, then we can be also floating better in that sort of a scenario and start getting more capital flows. I know that it sounds very odd to think about it that way, but the quantum of inflows probably matter more than the relative share of flows between India and China. The debt side, anyway, India had a relatively lower share of flows. That is going to change after this bond index inclusion. I don't think that will materially be impacted by the China story. But last, I must say that at this moment, the questions that are posed on China are very, very fundamental in nature from the investor's perspective. So just 1 or 2 quarters of good Chinese growth are not going to remove those questions. So when you're saying that China will recover, that recovery needs to be a very broad-based recovery with a lot of boxes to be ticked.
Any questions from here?
So I'm Bhavesh Bhatia from Accurate Study Center. My question is to the panel. The credit rating of India is low since past 20 years due to biased opinion of Western credit companies like Moody's. So it might not become, it might not be a specific reason for spillover, but it could be a resistance to India becoming a developed market.
Sajjid? Biased opinion of credit rating agencies, and that is stopping us from becoming a developed market. Do you agree, first of all, with this?
I mean, credit rating agencies have their own framework. So, the weight that is put to fiscal deficit, public debt, in some cases, per capita income. So some of the parameters that are used to make an assessment, and you're comparing different countries, the framework is such that India ends up ranking low despite having faster growth, despite reforms, despite better external fundamentals. So it's their framework. I think it is what it is. But I don't see this as a constraint. Like if you look at the dollar bond issuances that are ongoing offshore, the spreads at which companies are raising money is very tight, and it's actually much better than BBB minus rated already. So effective on the ground is actually reflecting much better rating, even though sovereign rating is at BBB minus. And I don't see this as a constraint at all. I think if we continue to do what we need to do, rating agencies will catch up.
Just one very small point. I'm sure most of the people in this room know this, and I'm not a representative of any rating agency, but there should not be any confusion that the rating is on the sovereign's ability to repay. It is not a rating on how good or bad the economy is. And because it's a rating on the sovereign's ability to repay, for obvious reasons, the fiscal parameters will dominate the rating and not how good we are doing on 15 other things.
Repay foreign long-term debt. Yes. Yeah. Another question, please. We can go there.
Debt to GDP ratios are not falling.
Yeah.
See, we had this debate in the inaugural session when Ananta was there. We had this again, and this is the third time I'm seeing a rating question coming back. What is very significant is that we touched 89% of the GDP on the pandemic year 2020, but once growth improved, this came down. But we are stuck at 83%, and it's actually destined to, even with this fiscal consolidation, it's actually destined to marginally increase from here. So where is the issue? I mean, Samiran actually clarified that they give a lot of weight to the fiscal parameters on this. And we had heard Chetan on significant issues on this kind of very solid work on how the framework would occur for the debt management. Some suggestions were there. And we will have this discussion probably again when we discuss the bond index inclusion. But we need to be very clear that the ratings are a function of debt sustainability with the highest weight is on that.
So 2 points. One, Mridul, you have a question here. You did mention global debt GDP ratios are rising and US is at 135%. What are the steps to control this? And a related point to your debt GDP question for India, in the FRBM framework, correct me if I'm wrong, but we need to get down our debt GDP ratios to about 40-45%?
60%.
60%, sorry, 60%.
Yeah, but that's something now not being even considered on the card because we have a long journey to 60%. But I think if we are able to get down below 80% in the near term, at least some of the risks will wane. So I think we should first move towards that, and that's why this cut in fiscal deficit is extremely important and should continue. But coming to the other question which you just mentioned about the 135% sort of debt ratio for US, I have no doubts to my mind that this is going to be a problem, because today US is to face whether they should bring down the fiscal deficit from 9% plus number last year to below that, or let the debt ratios rise. And I think markets will be very sensitive, even though US has exorbitant privilege about the dollars, because if they sort of try to inflate the debt away, there could be also macro stability problems. So it's a very vexed problem that the US has. The bigger problem is even China. China is going to hit 100% debt to GDP ratio in the coming 2 years. And I think that is something which the markets would really rip it apart. And that basically, I think Samiran did mention, these are not short-term issues. So a little bit of it is not going to solve that problem. I think the ripple effects of China could even hit us, because EM are often treated as a pack. So we have to be very wary of how these are to be deflated.
Yes, sir. Go ahead. You want some? Can you hear me? Here.
Sorry. You want some interesting news? What happens in November if Donald Trump wins? You most likely will get a tax cut, which may blow the fiscal further. You may get an import tariff across the board, which will mean higher US inflation, which means monetary may have to be tighter. And if all of us just said that EMs have to follow to some extent US monetary policy, right? Think about those impacts. So I think we are, what is the Chinese proverb? We live in interesting times. It's going to be another interesting year till November, the first week of November.
But let me give an interesting trivia also, that the last time when this happened was post-World War II. US debt went up from 40% to 105%, and then came down to 50% within 10 years. So it's not that US has not done it in the past, and we can go into how they did it, but that example is also there.
So we are out of time. I wanted to give all my panelists. Sorry. Of course. Sonal, one sec. I wanted to give all my panelists their 90 seconds, but these guys have already taken it. Yeah. So Sonal, please.
No, I think there's been a lot of discussion around China and EM. I would say that, more and more we are hearing from investors in terms of EM ex China. Yeah. So I think people are taking a more differentiated view. And if, if we had known that China would be as slow as it has been in the last 24 months, and the kind of property sector issues it's seeing, I think we would all be very surprised with how strong growth has been in rest of Asia despite those spillovers. So I think the other countries have some growth buffers. Investors are differentiating. They are asking for EM ex China products. And I do think India is benefiting as a result of that.
I mean, the MSCI weightage for India, I'm sure everybody would have, know, 6% to 18% in how many months? It's about 2 years. That's where we have come. I mean, China is still at 24%, but in the MSCI weightage for Asia, India is at 18% today. So we have time for one last question, if there is one. Yes, please. The lady at the back. Yes, ma'am. We will get a mic to you. Yeah. No, mic works. You have to long press the. I learned that yesterday.
So one question on the liquidity situation. So right now the liquidity is in deficit, and some of the participants have been saying that RBI is kind of micromanaging the liquidity. So how do we, see the trajectory going forward? And if we see some easing, can we say that it is the start of the easing cycle by RBI?
So yeah, this is, as Professor Ashima Goel was saying to an earlier question, this is out of syllabus, but you can, guys, you can take it. Certainly out of syllabus for this session, but please.
Yeah, I think one thing that we do think is that in terms of the sequencing of policy reversal, it will start with liquidity before we talk about any kind of interest rate cuts. Therefore, the focus for us going forward has to be on the kind of liquidity support measures come through. But within that, I think it's important to differentiate between frictional and the more durable components of liquidity. Right now, what one should expect is sort of more frictional measures to address the liquidity. I think one thing we have not seen and which would help would be more longer dated VRRs for a larger quantum so that there is greater comfort around banking system liquidity. And if we get to a situation where liquidity is too ample, we can always do a VRRR and mop it up. But I think right now we need to see more longer dated VRRs and of larger quantum to at least address the frictional issue so that the weighted call rate actually does get closer to the repo rate. And as we enter FY25, depending on how the macros play out, I think we will probably need to use either domestic or foreign asset expansion to create more durable money supply in the system. But I do think liquidity is the first thing to monitor.
Thank you, Sonal. We are absolutely out of time. Thank you, gentlemen and lady. Thank you so much.
Thank you. May I request Professor Subhashish Ray to felicitate the speakers, please.